US equities roar back to new highs as tech stocks are back in vogue. European markets, however, struggle as the new COVID variant threatens the reopening. And a firm dollar keeps commodities under pressure. All this and more in this week's Macro Insight. So welcome back to Macro Insight. Today is the 29th of June, and let's take a look at these markets. Welcome to any free trialers or new subscribers. So what's been going on? So after sort of the initial FOMC shock that sort of took markets down, obviously we had a strong recovery, right? So here's your S&P chart. So we had the dip down, reached sort of the 4140 area, and then strong recovery, and then we kind of spent the whole of last week kind of eking our way back to new highs. But the momentum that we're making as we're making those new highs has not been particularly impressive, particularly for the S&P, and we'll talk about the Nasdaq in a minute. But the S&P is showing a few suspect signs to me. Now, we had talked about going into that middle of June expiry. There's a load of gamma keeping the market sucked towards that 4250 area, 42 to 4250 area. And once that went away, we thought the market would move more. And then it has started to move a bit more. So if you look at the short-term realized vol, like the 10-day realized, that's actually about 11.5 now, where it had got us in the single digits. It got down to about 7 or 8, right? So you have had a little pop in realized vol, but we've been getting sucked into this new area where the gamma concentration seems to be. So the spot gamma guys have been talking about 4,300 as being the new gamma wall area, where that's kind of where the dealer's max concentration of long gamma lies. And kind of the price action is kind of confirming that, because as we're going there, we're kind of running out of steam, right? So you look at these momentum indicators are rolling over despite the spot prices kind of eking out a new high, right? So that's signaling to you that, yeah, maybe there is some truth there that the market is going to struggle to break that 43 area in the short term. Yeah. And that seems to be what the positioning is making it difficult to get over that area, right? So we're going to need some sort of strong catalyst or reason to break through that area. If we then take a look at the Nasdaq, for example, that's been super strong, but even the momentum there, right? So you can see Nasdaq's making new highs at 14.5, but the momentum's not making new highs, right? So it's a suggestion there that maybe this market's not as strong as it kind of looks, right? Because you're not getting the momentum confirming what the price is telling you, right? So when you're seeing momentum making new highs and price making new highs, that's when you're like, whoa, this thing, get out the way. But when you're starting to see a few divergences like that, you're kind of thinking maybe there's some sort of reversal on the horizon, basically. Okay. Looking at the vol, VIX has kind of found a bit of a level around that 15 area. As I mentioned, the realized vol 10 days at 11.5 versus say 30 days actually sub 10. So that's saying the last 10 days have been a little bit more volatile than the whole last month, basically. And that made sense given that kind of gamma expiry went away in the middle of June. But if you look at the VIX level, you can see it's kind of basing, right? It's forming a bit of a base. It has had these kind of intraday spikes lower to around 14, but it seems to be kind of settling in at around that 15 area, basically, right? So, potentially forming a base around 15. And there is a case now to even say, because we're back to these sort of mid-teen levels, that even if we were to break higher, let's say, and S&P gets as far as 4,500 even, how much lower is the VIX going to go? And is it going to collapse at such a fast pace? Because if we break higher, we're actually probably realizing, all right, it's probably only going to go to 12 if we just kind of get sucked into a new area like 4,300 and just sit around there and realize 5 or 6 for a couple of weeks. Then yes, maybe a move down towards 12 on the VIX is possible. But if we break that 43 area, then actually I'd say there's a reasonable likelihood that the VIX might kind of floor itself at around that 14, 15 area. Yeah. And on that note, you know, if you look at the VIX futures, you've got July at 17.7 and August at 19.5, right? And August contains the Jackson Hole meeting, right? So Jackson Hole at the end of August is probably going to become something that's on everyone's radar as a potential date to find out exactly what the Fed is doing, right? With regards to tapering, you know, what they're going to do. Are they going to taper their mortgage bond purchases? What is the outlook look like for Fed policy? And you know, if that meeting is going to be the pivotal, if that date at the end of August is going to be the pivotal date, then there's a strong likelihood that the volatility surface is going to put a slight premium on that bucket, which will then filter through to the August VIX future, which may mean that the August VIX future doesn't collapse quite as dramatically as what normally happens to the VIX, right? So right now we've got July at 17.7, we've got spot VIX at around 15. There's a decent roll down there, and therefore the August should be rolling down as well. But we might find that the August kind of finds its level of support around 18 or something like that and doesn't manage to really go much lower than that, even when it becomes the front month, right? And that's something to keep an eye on. And that might present an opportunity to use VIX futures as your hedge as opposed to S&P options, S&P put options. Yeah. Okay, what else? So, you know, with yields remaining low, we bring up what bond yields are up to. 10 years just hanging around at 150. So nothing too exciting there. The 30s, 5s that shot down, you know, it's bounced, but it's still, you know, significantly flatter than it was, you know, pre-FOMC. 2s, 10s, kind of same story. So, you know, not the bond market hasn't really changed its message just yet. And then, you know, that's obviously put pressure on the reflation trade, right? So rotation away from things like energy, things like financials, things like industrials, and into tech, right? So that's why tech's done so well. Let me share this. This kind of relative performance of, if we plot the 10-year versus the relative between the energy sector and the tech sector, so the XLE and the XLK, that's been tracking quite well, right? So you've seen that, and just lately you've seen a bit of an unwind out of the energy sector. So like yesterday, energy was particularly weak, down about 3%, right? But the redemptions in this, the interesting thing here is to show you what positioning's been like in the tech sector. So people are just underweight tech and have been underweight tech, and that's what's been being addressed recently, right? So the outperformance of tech over the last month has been people addressing the underweight that they've got in tech. Now, how much that's been addressed and whether we're kind of back to where we need to be remains to be seen. But, you know, that's why things like the ARKK ETF have just been, you know, roaring back, because there were people who were shorting that thinking, okay, rates are going higher, all these long duration names are going to get killed. And that's completely turned on its head with what the long bond has been doing, and the fact that the market has kind of got its head around the fact that we're not going to get runaway inflation here, and yields are kind of not going to run away to the upside. So there's been a move back towards those tech stocks, right? So if I bring up the ARK ETF here, if you look at the chart on ARK, and that has got some serious momentum behind it, that rally, right? So you look how that's moved. Momentum's kind of at a local high. And then this level was the one that got rejected a few times, this 130 level. So it's going to be important what happens here on ARK, whether it can break above that 130 level and then head back towards the highs, which are, you know, another good 20-25% away. But, you know, people are starting to get excited about ARK again, and it's had inflows, right? It's had inflows of about 500 million recently. So money flowing back into that sector and into that innovation, into the idea that that's where you want to be parking your cash. Yeah, me personally, I'm still a bit skeptical. So, you know, but the US market has definitely been the pocket of strength, right? The US equity market. And part of that is because there's this underlying buyback bid, right? The tech sector has got all these buybacks going on. Even the banks, Morgan Stanley announced a buyback, what they're going to do with regards to buyback. So there is this underpinning of the US market from buybacks, which, you know, makes it a very hard market to short, basically, right? So whereas you look at Europe, you know, the Euro stocks hasn't really recovered, right? So if we go back to the Euro stocks got to highs, sold off, kind of back to about halfway, right? So, you know, and there's a few reasons for that. It's obviously got more of a value tilt, Europe, and value's not been as strong as, say, growth and tech. So Europe doesn't have as much tech in it. But then you've got the emergence of the Delta variant of COVID, right, that everyone's getting scared about now, right? So you've got Europe numbers. If we have a look, UK is obviously, so we look at the share of Delta cases in the past 4 weeks of like new COVID cases. UK is obviously 90%, but Spain and Italy are rising, right, getting towards 20%. So, and on the back of that, people are worried that the reopening in Europe may get delayed, because obviously we had to delay our full reopening by a month in the UK. And the question is that going to impact Europe? Because Southern Europe's economy is reliant on the tourism, right? And that could throw a spanner in the works if that reopening gets delayed and the restrictions aren't fully lifted and people can't travel there, basically. So you know, you can see the impact of that on things like the SXTP, which is the travel and leisure sector in Europe. So relative to the Euro stocks, which is the broad Europe market, you're seeing underperformance in that sort of sector, that hospitality sector, basically, because people are starting to worry about the impact of that. And you had the likes of Goldman's kind of bring down their numbers for growth in Europe slightly, but we're talking basis points, like 10 or 20 basis points. They brought down their numbers, but really, if this is a real risk, those numbers could come down quite a lot more, given that you know, their economy is kind of leaning and relying on that a little bit. In terms of the data coming out this week to be aware of, you got China PMIs overnight. People are going to care about that. You got the OPEC meeting on Thursday, and we'll talk a bit more about OPEC when we talk about commodities. And then obviously you got non-farm payrolls. I'm just highlighting the main ones that I think are going to have potential market impacts, right? You got non-farm payrolls on Friday. And, you know, non-farm payrolls on Friday is going to be interesting because we've had payrolls that have been relatively disappointing last couple of months, right? And it's been because we said unemployment benefits and people aren't, it's not like the job vacancies aren't there. It's just that, you know, there's a mismatch between the skills of the people who are looking for work and the vacancies that are there, basically. And also the incentives to stay at home and not do anything, right? So that apparently has been rolled off a bit from state level. So it'll be interesting to see if the people have been encouraged to go back to work and whether or not there's been a bit of an uplift there in employment. But the interesting thing there will be that how's the market going to react, right? If we've got a beat on non-farms, we've got a strong number on non-farms, what's the likely impact on the dollar and what's the likely impact on the market, right? Because a stronger number on non-farms means we're closer to the Fed being able to taper, maybe, which makes the dollar rally and which makes risk assets not so happy, basically, right? So there may well be, and speaking of the dollar, we may as well bring up the dollar chart. You got the dollar here, and you know, the dollar had that big swing higher up to 92.5. It pulled back, but it was a pretty minor pullback, right? Relative to, you know, what we saw in equities and things, the dollar just didn't really budge, right? So it kind of found support at 91.5, and now it's going back up again, heading back to the, you know, the highs are, it's only 20 cents off the highs, right, in DXY. So I'd say, you know, realistic target, you know, now that we've unwound this really overbought sort of move, if we're going to go back up, a realistic target is maybe 93.5 as a first target, which is the top of this range that's been in place for ages. And that's really going to be your main pivotal point, right? Because if that breaks, then that could springboard us into like the 97.8 area, where that's a world of pain for risk assets, most likely, right? So, you know, that's the thing to watch. I think its probability is fairly high that we can get towards 93.5. I think if you look at some of the other charts, like the euro, that's good. Again, that's going to be consistent with about 1.5% down towards this 117 area on euro, which we tested previously. And then cable, cable could get maybe as low as 136 if it's a little bit higher beta than say the euro. So those are going to be levels to watch and to see what the dollar's doing at that level, right? But I think very reasonable chance that we're going to head there. Definitely feels that way in terms of how strong the dollar's been after that last leg higher, basically. But non-farms is going to matter. I would say non-farms is going to be your catalyst to decide where the dollar's going, right? If it is going to make those new higher levels, basically. Yeah. So if we take a look at commodities, oil, the big one. So it had a bit of a pullback yesterday, but it's bouncing pretty strongly today, right? It's pretty volatile. But it made sense that it should have a bit of a pullback before the OPEC meeting. We'd been talking about oil when it was breaking 68, that the target was 75. It got pretty damn close to 75. And OPEC had kind of said that was the range that they had for it, right? And 75 was like the top end of the range that they were talking about. So we shouldn't be overly surprised if the OPEC action is such to kind of promote a bit of stability within this range. So people are expecting a supply increase of about 500k barrels in August. So we'll find that out on Thursday. But, position squaring, there's going to be people who are playing that break in oil on the spec side, bit of position squaring going on. Oil has been a massive outperformer if you look across the whole commodity complex since the FOMC. So it kind of makes sense that you should have got a bit of consolidation in oil before that OPEC meeting. And that's kind of what we've had. Yeah. I do think 70, these are my levels that I've marked out as support. I do think that sort of 70 area or like 69.7 area will be a decent support area sort of going forward for the next few months at least. Delta variant is obviously wild card. People are saying that was a little bit the excuse why we came off. But I think it's going to take a lot for this Delta variant to really have a massive global impact to the extent that it's, we get shutdowns everywhere and oil demand collapses or anything like that. So, there's not as much political sort of will, it seems, to lock down so quickly and dramatically. And the fact that the Delta thing is not something we're not aware of, right? It's a known unknown, yeah. So that means the impact will generally tend to be a bit less, yeah. You've got metals, which have been under a bit of pressure, obviously, and that's the whole lot. That's precious metals, industrial metals, everything. So this chart kind of shows you some sort of speculator positioning, how it's been kind of rolling over across the whole space, right? So that yellow line on every chart is basically the net positioning of long and shorts in terms of the specs. And that kind of shows you that sort of copper positioning has got a bit back to neutral, platinum, same thing, gold and silver rolling over. So decent percentage decreases in like the positioning across the whole complex, right? If we bring up the chart on these, on copper, for example, and I'd been saying, I think that copper's vulnerable given what China was saying on it and given how elevated it was. So we definitely got the correction. I do think the correction could go as deep as like 380, 385, because that does seem to be, I don't think we're out of the woods quite, just yet in terms of, the hawkish pivot, things like that. I think the dollar's got some legs to go higher. So all of these things would suggest to me that the copper correction probably isn't over. But where you would expect it to find some pretty decent support would be around that 200-day moving average. It's got some fib confluence down there as well at 385. That's probably an area where I'd be quite happy to kind of scoop up some longer term positions in copper again. Right now, I'm not running any tactical positioning in copper, right? Okay, so that's copper. And then gold, probably the other obvious one to look at, has been pretty pathetic, right? I mean, in fact, gold's just got whacked as we speak, yeah? So gold it kind of had a pathetic bounce. It got to those 1760 support, bounced to around, not even 1800 and then rolled over again, right? So, and given that real yields have kind of moved back a bit as well, that the move in gold or the lack of bounce in gold was quite bearish short term. And it's because the dollar's so strong, right? So you've got real yields and the dollar are probably the two things that impact gold the most. And it seems like the dollar move is the thing that matters the most right now. So breaking this level at 1760 doesn't set up very well for gold. I mean, that kind of means that the chance of testing that 1680 area in the short term has gone up, right? If that level breaks. So it's kind of trying to break as we speak. Let's see if it manages to close down there, but that opens up room to go back to those lows and maybe even break those lows at some point, right? Depending on what kind of the dollar's doing and what real yields are saying. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.